Welcome everyone to this webinar. My name is Kamal Manocha. I represent PMS AIF World. Another Friday, another webinar, and today we have Mr. Rajiv Sobti with us. We have invited him as one of our speakers to get a global perspective. We being in India, have always been reading over last, especially 1 year, that world is going to be hit by a recession starting from US, COVID-19, as well as the war going on between Russia and Ukraine has kind of, led to this. We have also been reading that India more or less is less impacted because of this recession. But we'll come to, the second part maybe later. But the first part, we want to understand that, what is the reality of the recessionary risk ahead of us. And, we are glad that PMS AIF World could go global, through this webinar, wherein which today we are going to cover this, from the perspective of a global fund manager. Mr. Rajiv Sobti brings with him more than 3 decades of experience, particularly, into equity markets. He did his MBA from IIM Ahmedabad in 1977, followed by which did his, PhD in finance from University of Pennsylvania in 1984. And since then, he has been involved with financial markets. For last more than a decade, he has been managing public money in his own company, Karya Capital. He is a CIO there. And I know him, since last 3 years, and he has been watching our webinars since we have been doing this every week with all India focused fund managers. And because now at this juncture, the issues are again more global, and it is to do with US recession. So that is where, we thought of doing this webinar to understand the perspective of recessionary risks ahead of us, the reality of recessionary risks ahead of us. Welcome, Mr. Sobti. I know, your throat has not been keeping well. I am kind that, it's kind of you that you have accepted this invitation. So to begin with, we want to understand from you, what is the reality of the recessionary risks in front of us, and, how do you see them? And then we will maybe, ask further questions. The foremost question is, what is the reality of the recessionary risks ahead of us?
Hi, good evening and good day to everybody. It's a pleasure to be on this forum, and thanks, Kamal, for inviting me. It's a complex question because the recessionary risk is going to be shared very unequally over the coming year by different economies in different countries. And the reason for that is that the starting point of different economies was very different. Essentially, we started with a global inflation problem, and there was a series of central bank actions to curb that inflation. But the biggest problem and the most stubborn problem is in the US. It's the biggest problem because it is driven by labor force costs that are notoriously stubborn rather than just supply bottlenecks, which was an issue that several other economies faced. And energy, which was faced globally, but Europe bore a disproportionate share. And the reason why I'm saying that is if some of these issues get alleviated, and energy is a one-time shock, there is a base effect. And once that base effect dissipates, the inflation will come down. But labor force costs and housing costs are somewhat longer lasting, and that is the most acute problem in the US. And the US is in the strongest position to withstand monetary policy, given that the fiscal injections were very large. The US government gave a tremendous amount of spending power support to the US population, as a result of which they have the ability to withstand a good bit of monetary tightening. And also remember that the US has not had an energy shock of the magnitude that the other economies have borne, because it's self-sufficient in energy. So therefore, it means that the central bank will tighten a great deal more than would be needed from the global perspective. And US will be the last one to show the weakness in the economy. But a lot of economies in the meantime, particularly those that are vulnerable to US growth, and to a stronger dollar because they have overseas liabilities that are financed in A, in dollars, and B, have floating rate components to them. And a number of countries have floating rate liabilities in general, such as Australia, Canada, and UK. So they all will have their own domestic squeezes. So I think, to answer your question directly, Europe and parts of frontier emerging economies have already had a very hard time, including Pakistan, Bangladesh, Sri Lanka. China has had its own unique issues, which are unrelated to monetary policy, which is a payback for years of unbalanced growth driven by a property sector that was unsustainable. So China has its own slowdown going on, but that will be further exacerbated by what I just described on the US monetary policy side. So the Far East, particularly economies that are most linked to China, frontier emerging economies, parts of Europe, will have the deepest downturns. How deep the recession is depends on to what extent the energy shocks resolve, the geopolitical risks resolve, which is a bit hard to handicap at this time. But suffice it to say that as of now, given the facts as we know them on the ground, a substantial slowdown in global GDP growth to barely 1.5% to 2%, up from almost 4% plus, with that burden being shared quite unequally in Europe and certain emerging economies, which will go through negative GDP growth, is a likely scenario.
Sure. So what do you how do you see the next Fed's policy, which is expected to happen in first week of November, after a series of rate hikes?
Yeah.
You expect the stance to continue even in the subsequent policies?
Yeah. So I think, unfortunately, the inflation is a very lagging variable in that even after the economy starts to slow down, the underlying inflation pressures don't dissipate right away. And the most recent CPI yesterday was evidence of that. And as a result of which, another 75 basis points, the forward markets have priced in fact, more than 75 basis points for the November 2nd meeting. They've priced in almost 80 basis points, followed by another 60 basis points on average, which means that they are giving some probability to a 75 basis points increase in December, taking the US policy rate almost to 4.5 and higher, with a terminal rate currently priced in of about close to 5%. And that is quite a penal rate. And given the strength of the dollar, that'll happen or has already happened and will likely continue in the near term. The dollar is expensive, but it is the safest currency with the highest highest policy rates in the developed world. UK is expected to also go significantly higher because of now likely reversed fiscal actions by the authorities. So now their policy expectations have moved down. But they also expected to go, even as of now, over 5%. It was priced at about 6% recently. I think Europe will be the least reactive central bank because they have enough weakness on their own, whether it's energy or whether it's effective rationing. Their policy rates will be closer to about 2.5, 2.75. The reason I'm giving you the other central banks is because they together determine how much tightening pressure and how much recessionary forces through slowdown in demand can come through. So I think the US is the most important because of the role of the dollar and because it's the biggest economy. But I do think that most other central banks that drive monetary policy will have a hawkish stance. Now, inflation could surprise us, which I am not optimistic as of now, but over time, I go back to the magnitude of the problem in the US, where the unemployment rate is very low at 3.5%. And we will probably need to raise the unemployment rate to close to 5% for the inflation problem to be solved in the US, which will ensure a mild downturn, being a recession of -1, -2 for 2 quarters, which means that the other economies globally, and India is, of course, an exception, I'll come to that in a minute, but most other emerging economies, including Europe, including parts of Asia, Far East Asia, and particularly those affiliated with China, will have significant downturns. Philippines, Indonesia, Thailand, Vietnam, even though they have very good windfall gains as India is getting from the outsourcing out of, I should say, reshoring out of China, they will also feel the effects of weaker demand from the US. Because remember, the US imports have been a major source of support for the global economy after the pandemic. And if we, as in the US, suffer that downturn, it will have global ripples. And I think the financial market ripples could be worse than the real economy ripples, because the financial markets tend to be far more forward-looking, and they compress the total effect of the downturn into a very short period of time, which is what we will probably see in the next few months, that the real economy cycle will continue, but the financial markets impact will largely be completed in the next quarter, because financial markets are forward-looking. And remember that equity markets bottom almost about 2 to 3 months before the real economy bottoms. So they look forward. So I expect the trough of the financial markets, the risk markets, that is, in the next 1 month. I do expect bond yields to stabilize, because the economic slowdown will stabilize the long-term bond yields, even as central bank policy actions will also be completed. And with some lag, after we have had some weakness in the risk markets, they will eventually go up, even while the recession is in progress.
Sure, Mr. Sobti. So, another subsequent question that, I have on my mind, after yesterday's, IMF's meeting, where IMF mentioned that in the times of gloom, which you're also acknowledging, where China has its unique problem, UK is already, under pressure, US is also showing slowdown. In such times of gloom, India is termed as a bright spot. And, as per IMF also projecting that by 2028, India could be world's third largest economy. So how do you see India placed currently in these risks? And in that context, what are the factors that an India-focused equity investor should keep in mind?
I think India's unique position as a much less open economy, but supported by long-term FDI flows and the digitization of the economy, has given it unique advantages that I think will enable it to outperform global economies on a medium-term basis. There is no question about that. The question is also of the policy mix and the nature of the capital markets, and whether they provide you a fair exposure to the underlying economy, as in, are they adequately represented? The real economy is adequately represented. Is a valuation of the companies that are used in the main indices skewed for one reason or the other? And one of the questions you'd asked is, what has happened to the FII flows? And honestly, the FII flows are driven by several complex factors. Relative valuation, at least using historical metrics, is one driver. And India certainly looks expensive by historical metrics to its own valuation. Now, if you completely change the trajectory of forward earnings growth, that multiple can be justified. And in fact, you may have only a modest adjustment in the multiple. Most of the global markets this year have had an adjustment of multiple, and particularly China has had a dramatic derating because of its own earnings issues and structural issues that people have lost faith in the system long term. In India, there is no loss of faith. There is a view that over time, this will be the major star in the global markets, given all the reasons that we've discussed. This assumes a policy mix that is supportive and provides a framework for good, well-balanced growth. The policy mix is both in terms of fiscal deficits. It is in terms of energy policy and how much current account deficits will be increased by energy costs. So I think that generally speaking, India represents an outstanding opportunity from a medium-term basis. In the near term, and that's the reason why FI flows have been so skewed on the downside, they see a near-term negative downdraft in global markets, while India has withstood the negative pressures quite well, as a result of which it has outperformed. Now, of course, the earnings has been an important factor supporting India. Its earnings have been extremely strong. But into next year, as the growth rate comes down in India potentially to about 5.5, 6, and the earnings growth comes down, and the relative valuation, which is the last variable, relative valuation has to be, even if giving yourself the benefit of medium-term earnings growth, the relative valuation still can be marked down by 1 to 2 turns of leverage, which is about 5 to 10% correction, broadly speaking.
Right. So, there is one question which I see on the chat box, which I think is a relevant question,
Yeah.
which says, given that dollar is a primary global currency, the US monetary tightening is having a disastrous impact on economies around the world. This has led to strong views on ending the dominance of dollar on the economy. Is something like that bound to happen over next, say, 5 to 10 years? What are your views in this regards?
In my opinion, absolutely not. I think the role of a stable currency, which people use as reserves, is driven both by the nature of trade flows where they're invoiced, because that drives the currency for undertaking the business of the world, number one. Number two, a stable political and economic system. And number three, long-term acceptance of that economy as a dominant economy. If you look at the choices and which, for example, currencies that are part of the special drawing rights of the IMF, you have the euro, you have the British pound, you have the renminbi, you have US dollar, and a host of other currencies. The vulnerabilities of each of the alternatives to the dollar as pertains to the economic or political structure has been displayed amply in the last few months and last couple of years. China, I think, has lost its future role completely, not just for economic reasons, but the way it has isolated itself as willingness to work within a global framework of institutions. UK is a economy which has seen its best years several decades ago. Europe has its own unique problems of a heterogeneous group of states which are bound together by common currency, but by very different fiscal policies, as a result of which it's still a very unbalanced economic unit. Historically, the dollar has proven to be the most stable currency in times of crisis. That has been proven again and again. And the reason is that the US has always been a safe haven, both in terms of its underlying capital markets and in terms of its underlying economic and political framework and foundations. So I don't see an alternative to that.
Sure. So, over last 6 months, US markets represented by Dow Jones and Nasdaq have actually corrected far more than Indian markets. And while you mentioned the beginning that you expect US to be the most resilient economy, however, its capital markets are actually, representing something else. So why is this dichotomy? And do you see US markets have actually made a bottom, because we saw yesterday markets going up by almost 3%, or you
Yeah.
see it's just kind of a blip, and we will see further markets going down?
Yeah. So the US economy, the broadest representation is the Wilshire 5000. The S&P 500 is a very, should I say, skewed index because it's dominated by certain technology and software stocks, which were driven up during the pandemic and were the beneficiaries of very low real interest rates for many years. And so the adjustment was for those stocks in particular in response to the real interest rates, which rose in the US from -1 to 1.6%. So that move alone would have caused about a 25-30% decline in stocks without any change in the impact of earnings or any change in the equity risk premium. So the sharper adjustment, if you in the S&P, is quite different from an equal weighted, even within the 500 S&P stocks, equal weighted index like the Invesco ETF RSP, or the much broader index Wilshire 5000, which is much less skewed by the weightings of these mega weights, mega cap giants. So I think that the weakness of the US market is driven to a very large extent by the much needed adjustment for these large cap technology giants. And it's not reflective necessarily of a earnings expectation now, but more an interest rate move. The earnings adjustment is now still ahead. And if this year the S&P 500 earnings per share is, let's say, $225 to $230 dollars per share, next year it is likely to decline at least by 10%. So we still have a adjustment stage driven by earnings, not by interest rates. And that stage is still ahead of us. Yesterday's move from the 3,500 just below 3,497 was driven by long-standing buy orders to buy at certain levels, people who have de-risked. It was driven by short covering. And in bear markets, short covering rallies are probably the most vicious ones. You can get multi-year moves in short periods of time on the upside, only to give up all of that and more. And we've seen several bear market rallies. We saw one from late June to early August, all of which was reversed and then more, because the underlying fundamentals of the equity markets, which is monetary policy and earnings, that adjustment was not completed. And I expect that we could have a potentially slightly greater rally, slightly further upside move, maybe to 3,800. But the process of the final low has still not been completed. So I think that adjustment is still ahead for us. So in my opinion, we are in a late stages of the decline, but the decline will be completed when typically you see troughs in what we call here the monthly reports on economic activity, which we call ISM, Institute of Supply Management Surveys of Managers, which is a real-time report card on the economy. Typically when that, and currently it's running around the 50s, typically when that is around the 40s, low 40s, that means that the momentum is finally troughing. So the economy and its momentum has not troughed. Monetary policy is still on a tightening trajectory. And the last variable is the balance sheet contraction. That is a very important source of liquidity withdrawal in the US and in global markets. That is almost to the tune of 100 billion a month. That is a lot of liquidity that is being sucked out of the market because the central bank balance sheet is being contracted. That the effect of that is not to be underestimated. And that has tremendous ripple effects, not only on the price of credit, but the availability of credit. Because what has happened is, as the central bank contracts the balance sheet, bank reserves decline, and then the contraction of lending takes place in the whole economy. Furthermore, the risk-based capital ratios are being raised for all commercial banks. And therefore, you will see an impact on lending and on the real economy, which goes beyond just the cost of short-term borrowing, which may largely be completed around 4.75%, 5%.
Sure. So far, whatever we have discussed, I think what you're trying to convey that quantitative tightening is what, began the problem, and it was to address inflation largely as one of the concerns. But even till date, as per yesterday's numbers, inflation has yet not shown signs of, kind of coming in control. So what do you think, whatever actions that Fed is taking in terms of trying to increase interest rates to tackle inflation, are they in the right direction, or you think there is inflation is because of supply side factors, or because as you mentioned that at the moment the kind of fall we have seen in Nasdaq and Dow Jones is more kind of factoring in the rise in interest rates. The possible fall in earnings is yet to be kind of incorporated, and now all the more when interest rates are being risen, it will impact growth, it will impact earnings. So don't you think the steps that are being taken by Fed are kind of counterproductive and maybe can lead to further risks in terms of downgrades, in terms of earnings growth? So in that context, what are your views? How do you see Fed actions?
So I think the Fed has a completely, should I say, unambiguous mission to provide a stable framework for growth, because they see the stable framework as most conducive to long-term employment and long-term welfare of the economic actors, be they corporations or be they the labor force or households. And a stable framework is defined as a 2% inflation, which, as we know, that we had a deep recession in the 80s by Chairman Volcker, to basically address an overshoot that was running in the 8-9% inflation range. We are still running around 7.5%. And the central banks, even if they engender a recession, have a global commitment, whether it's in Europe. And Europe, it's even a more deeper challenge because the growth is unambiguously going to be in a recessionary mode, even as they're raising rates. The US, we don't have so far any signs of recession. It is a likely outcome next year, but so far the growth is still running quite robustly. And payroll growth was running close to 250, 300,000 workers a month growth, which is consistent with almost 2.5%, 3% GDP growth. So I think that the hard trade-offs are ahead when the economy slows down, and the Fed will maintain its monetary policy stance, including quantitative tightening. As I said, Europe is facing an even deeper challenge because they could be in a negative growth scenario by fourth quarter this year, and yet they will be raising policy quite actively. So I think the central bankers are viewing this as short-term pain for long-term gain, in that if they sacrifice the inflation mandate, it creates for a great deal of uncertainty in the economic environment and leads to poor growth medium term because of all the uncertainty imposed on all the corporations and people. And it's a fact that high inflation environments have suffered the worst real growth. So I think they will, of course, a few years ago they were worried about deflation. As recently as 2020, when they undertook a new framework of policy called FAIT, flexible average inflation targeting. And now there's no question their focus is to make sure they don't sacrifice a 2% inflation mandate. And the problem is that even next year, by end of next year, we'll still be sitting at 4% inflation or so on. So it will take a long time, and the central bankers are willing to stay the course unless the deep recession intervenes and brings the inflation down faster. So I think that the central bankers are unequivocally committed to a inflation framework, even if the short-term costs are a recession. A deep recession is not in their base case, either for ECB or for the Fed, because otherwise it'd be very hard to justify raising rates if there's a deep recession. They anticipate slowdowns. In Europe, they even anticipate a potential negative GDP, particularly in Germany and Italy later this year. But their commitment is unwavering. And I think the economic history track record has proven that that is a justified commitment to that policy.
Sure. So, all of us who have been into equity markets have understood and learned that equities always are ahead of times. And now when we're talking about it could take longer than expected, and there is a short-term pain for a long-term gain. If we were to put it into perspective of time and trying to understand the behavior of equity markets, how much more time equity markets, you think will take to incorporate this short-term pain if you were to kind of project certain, levels, say over next 6 months to 1 year, with regards to how US markets would behave. I want you to kind of state your views in that regards.
Sure. I think that one thing we have to remember, Kamal, is that financial markets are non-linear. They don't follow smooth downward trajectories or upward trajectories, as we all know, even though economies may be much more slower moving and much more linear. And for that reason, it's a bit hard to project that if there's a financial accident, if we reveal that there is some major global entity that is at risk, whether it's a sovereign economy or it's a financial institution which comes under severe stress because of the monetary policy, you could get a earlier and a much more compressed decline than, for example, I would expect. I would expect that the economic, or rather the equity damage, will be a function of what is happening on the ground in terms of inflation, because monetary policy is completely joined at the hip to inflation. But if inflation proves to be stubborn, the outlook should be a steady move lower. I would say a multiple of inflation might greatly surprise us on the downside. We might get very lucky with energy shocks. But how that 15% comes about, and this is the US, I don't think India needs to go through that move. I expect a more magnitude of 5 to 10%, largely because of the earnings buffer and the lower sensitivity to global growth for India. But India, as I said, also has its near-term inflation and current account deficit and general government budget deficits to deal with, which, and I think the Indian rupee has more depreciation to go, by the way, just because I think that the price of oil, as it's risen and may stay high, will impact our current account deficit adversely. But that aside, I think India will withstand this decline probably the best, even though it's got a valuation premium. But the earnings buffer will provide, and the domestic retail buying support will be a source of now medium-term source of buying power. But I do think that most likely by first quarter next year, the bear market will be completed. So we probably have another 2 to 3 months before the financial markets try, and the earnings season that is starting in the US starting today will be very revealing as to what the impact on earnings is, what the impact on margins is. Intel has laid off about 20% of his workforce, largely because it expects a sharp contraction in profitability. Amazon, FedEx, all of them have, in a sense, already pre-announced by virtue of their corporate actions. So I expect earnings to be on the downside. I think by the time the earnings season is completed, we'll have a pretty good idea of the earnings markdown this quarter and probably next quarter, because we'll get guidance for next quarter also. And I think at that time we'll be in a pretty good position to assess the potential downside, and we will have largely priced in the impact of this whole slowdown in the US and globally, and the interest rate component also, I expect to be largely completed, and the negative effects to be largely out of the way by early next year.
Sure. So the million dollar question and the last question, of this webinar, what is your one piece of advice for our long-term investors who are focused on Indian market, and at the same time, who over last 10 years have kind of started to diversify globally, especially to US markets, because last 10 years have been very good for US markets, led by some of the technology businesses. So some of these investors who today are in their, say, 40, 45 years of age and have 10, 15 years ahead of them are long-term investors, can take risk of, being invested into equity markets. So how do these investors see current times, and what are the kind of, I would say, points of caution that they should keep in mind, and how should they view, current global challenges, and how should that impact their strategy?
Yeah, let me try and unpack that question in different components. Excuse me. So in the near term, well, let me make a general statement first, that the leaders of the previous bull market rarely are the leaders in the next bull market. And that's one general statement I'll make. And of course, the tech bubble of 2000 was the most extreme example of that. But in generally, it's highly unlikely the Facebooks, the Amazons, the Googles will necessarily be the leaders of the next bull market, which of course dominate the S&P 500. I expect the set of winners to be much more diverse, whether it's energy, banks, new industries that are coming up, even things like defense, not just defensive stocks like healthcare, which I'm very bullish on both in the next 6 months as well as medium term. Those have secular drivers that have enduring, and the valuations are not at a significant premium compared to the market, which is unusual. So I would say both for the near term and medium term, I would not chase tech. I think the tech earnings are still to be marked down. Google, Apple, Facebook, of course, has its own story. Netflix is a whole different story. But there is a great deal of cyclicality that is still to be felt in, for example, Google's ad earnings, et cetera, et cetera. So I would be looking at long-term durable franchises. And to me, a current barbell of healthcare and energy gets you out of cyclicality, even though energy is traditionally cyclical. It has some medium-term positives. I think healthcare is a very good place to hide out in the storm in India or globally in the next 6 months. And over time, when the cyclicals get beaten down enough, of course, the cyclicals will come back. But I would not chase tech, because I think one of the main reasons tech did so well since 2000 is since 2003-4, is the steady decline in real interest rates. And they are the longest, if you will, tail cash flows or longest tail earnings, and are very sensitive to real interest rates. I don't expect real interest rates to come down dramatically in the next few years. And by the way, healthcare gives you almost that same exposure to real interest rates in terms of improving when real interest rates come down. So my focus would be both in the near term and medium term, not to just go with the popular indices, but to look at a careful sectoral selection. I know ETFs may not be as popular in India yet as they are in the US, but in the US, you can create almost a menu of tailor-made portfolio you can create by looking at a menu of exchange-traded funds, almost as though that you were picking individual stocks. So I would be much more sector-focused than, quote, blindly buying the indices, because the indices may be representing weightings that may not be most beneficial to long-term growth.
Sure. So, talking a few about, sectors, I know I mentioned that's the last question, but, it's giving me some more interest to kind of continue this maybe for 5 more minutes, if you allow, Mr. Sobti.
Yeah, go ahead. Yeah, go ahead.
So within healthcare, when you mentioned, what do you mean by healthcare is kind of a good, way to kind of park yourself in the storm, as you mentioned.
Mm-hmm.
So can you please elaborate that, because healthcare is a very broad statement.
Absolutely.
Yeah.
So healthcare has 4 different key components: pharmaceuticals, managed care, devices, and then life sciences and supplies. And I think that certainly managed care is a growth market in the US, but it's not as prevalent in India, or it has become increasingly prevalent. But I would say for an aging population globally, pharmaceuticals, India is not an aging population as much, but the needs for, as we go up the income spectrum, the need for modern drugs and need for more medical care on an individual basis will become greater. And so I think the whole spectrum of those makes sense to me. I think the pharma and devices and medical supplies is a good, stable component. And I would frankly, within that, pharma is probably my most preferred segment. But I would say that all the components have their own merit in terms of medium-term positives.
Sure. Within Indian context, we hear a lot about the great future in the near term about manufacturing sector, because a lot of reforms have taken place, and now there is a China plus one effect, which is kind of shifting a lot of orders and a lot of opportunities to Indian manufacturers. How do you see the sectoral part within manufacturing sitting outside of India, say in US? So you also represent FIIs, because you also run your own billion-dollar fund. So from that perspective, if you have to allocate your money to, say, Indian market, how do you see manufacturing side? Because we hear and we read that India is largely always seen as a services led economy, but there is going to be a structural shift which is happening over, say, this decade, where from services led economy we are going to be a manufacturing led economy. Do you feel this change in perception, and what are your views in this regards?
Yeah, I think that's a very good question and an excellent point to focus on, that historically the services have been India's shining stars, because the domestic manufacturing has been very inwardly focused and not necessarily export superstars. I think the problem and the validation of manufacturing comes in the international marketplace. That are they purely domestic markets, domestic market serving, or are they internationally competitive? So if you look at, excuse me, the giants of Korea, Japan, they prove themselves in an international context. India will have to see whether it has manufacturing, will be able to develop manufacturing competence that is globally competitive, because that'll be the ultimate challenge. But let's say you focus just on the domestic component. there is no question there is a renewed from reshoring China Plus policy that you mentioned, China Plus One policies. There'll be a renewed opportunity for either the existing dominant companies to diversify, or take some of that space, or for new companies to emerge, or for subsidiaries of overseas companies which are wholly owned subsidiaries to operate. And I would say that all of those do represent an area of opportunity and diversification than has been the case before. Excuse me. So I think manufacturing, in a nutshell, will represent a much larger portion of GDP, and the companies that will benefit from that greater component of GDP, as we become a manufacturing hub in addition to a services hub. But I would say that the jury is out as to whether these will be internationally competitive, whether these will be long-term winners, or just domestically serving companies that will be, I would say, on a decent rate of return, but always looking over their shoulder whether they could be overtaken by overseas giants. So in India, the labor arbitrage, the dollar cost of hour of productivity was a dominant factor. I don't expect that to happen in India because so far we don't have the economies of scale. It'll take time, Kamal, quite honestly, to develop that scale, to develop those efficiencies, to develop those internationally competitive companies. But certainly, it will become a more important segment of the economy.
Right. You also mentioned that energy views on energy sector, and if I remember correctly, around 2.5 decades ago, energy used to be the largest weights in
Absolutely.
US markets, and then it has now been taken by tech businesses. So do you think this getting rebalanced over this decade as a long term shift in US markets, or it's not going to impact the weights that much?
Yeah, so I think energy is a very critical sector, but in transition from pure fossil fuel dominant to a combination of fossil fuels and renewables. But I think the role of fossil fuels is going to be dominant for at least another decade or longer. And we've seen that nuclear has not been adopted very easily, and renewables are still availability of energy from Russia for various reasons, not least of which is because they may not want to depend on Russia in the future. I think there'll be a variety of companies that'll be called upon to fill that gap, whether it's US companies, whether it's other global companies. So I think that the price of energy will be much higher than was the case in the years leading to the pandemic, which makes for a good revenue stream. And I think the oil and gas sector do represent, and it is a fuel still of emerging market growth. India has gone great lengths towards wind, towards solar, etc. But it still will not be able to channel, and hydroelectric, of course, but it still has a great dependence on oil and natural gas, and of course, oil will be a huge importer of oil, which is a liability for us. So I think the domestic sources of oil, domestic companies, if there are increased focus on those developments, those will be very good opportunities. But I do think energy has already increased its share from being the most and largest share, as you pointed out, of the S&P 500. It even now is barely 5%, which is a very small percentage. So I do think that energy will play a bigger role in capitalist market cap, and also in the overall share of GDP, because its role will become more critical in different ways. So I think that the energy share, which is still barely 5% or thereabouts, can grow to about 8 to 10% in the coming years. So I'm very bullish medium-term energy.
Sure. So this is the last question. I want you to kind of, select one of the following three options,
Yeah.
with regards to your views for Indian equity markets, for Indian equity investors, say over next 3 years. Are you optimistic? Are you pessimistic? Or are you cautiously optimistic?
I would say if I was to invest now, my perspective will be cautiously optimistic. If I was to invest 6 months now with more clarity and more comfort, some of the near-term negatives have been largely priced in, I'd be certainly very optimistic, because I think the medium-term opportunities are very large. So that's the way I would describe it.
Sure. Thank you so much, Mr. Sobti, for your time today. I think, it has been a very, very insightful session. I think, our audience would have learned a lot. And I'm sure you also kind of, liked answering some of these questions.
Yes, very much.
Thank you so much. And thank you everyone for joining us today. Thank you. Signing off from here. This is Kamal Manocha from PMS AIF World. Thank you, everyone. Thank you.